If you've been looking for ways to generate monthly income from your investments, you've probably come across ETFs that hold Canada's big banks. And on the surface, that makes sense. Canadian banks are some of the most stable, most profitable financial institutions in the world. But here's the thing. Not all bank ETFs are built the same way. Some are designed purely for growth. Others are engineered specifically to pay you as much cash as possible every single month. And a few try to strike a balance between the two. In this video, we're going to compare 5 different ETFs that all give you exposure to Canadian banks, but each one takes a completely different approach to generating income and growth. By the end, you'll understand exactly how each one works, and more importantly, which one actually fits your goals. Because I'll say this right up front, the best ETF isn't always the one with the biggest yield. Let's get into it. Before we compare individual funds, it's worth asking, why do so many income investors gravitate toward Canadian bank ETFs in the first place? Part of the answer is the Big Six: RBC, TD, Scotiabank, BMO, CIBC, and National Bank. These institutions have paid dividends for well over a century, survived multiple recessions, and remain some of the best capitalized banks anywhere in the world. Owning a basket of them through an ETF gives you diversified exposure to that stability, without having to pick which individual bank might outperform the others. And that's really the appeal of a bank-focused ETF versus buying one or two bank stocks yourself. You get instant diversification across the sector, monthly income potential, and you don't have to guess which bank will have the best quarter. But how much income you get, and how much growth you give up to get it, depends entirely on the strategy behind the ETF. And that brings us to the most important concept in this whole video. Before we compare these ETFs, here's the most important idea I want you to remember. A higher yield does not automatically mean a better income ETF. In most cases, it simply means the fund is using a more aggressive strategy behind the scenes. Many income ETFs generate extra cash by selling covered calls. The more aggressively they sell those options, whether by writing calls closer to the current share price or on a larger portion of the portfolio, the more option premium they collect. But there's a trade-off. The fund gives up more of its upside if Canadian bank stocks rally. Some ETFs also use leverage to boost both income and returns. That can work very well when markets rise, but leverage also amplifies losses during market declines. This is why I don't think investors should focus only on the highest yield. In fact, combining different types of bank ETFs can often be a smarter approach. You can own one ETF that prioritizes long-term growth, another that provides a balanced mix of income and appreciation, and another that generates higher monthly cash flow. That way, you're not sacrificing all of your growth just to maximize today's income. As we go through each ETF, don't just look at the yield. Ask yourself, what is this fund giving up to produce that income? That's the comparison that really matters. Let's start with the fund offering the highest yield on this list. Bank, currently yielding around 11.71%. That's an eye-catching yield, so it's important to understand where it comes from. Bank combines two different strategies. First, it uses approximately 1.25 times leverage, meaning it borrows to increase its exposure to Canadian bank and insurance stocks. Second, it writes covered call options on up to about 1/3 of its portfolio, generating additional option premium that helps support its monthly distributions. Unlike some other high-income ETFs, Bank doesn't write covered calls on its entire portfolio. Because only part of the portfolio is covered, it can still participate in some of the upside when Canadian financial stocks perform well. The trade-off is the leverage. If Canadian bank stocks have a strong year, leverage can boost both returns and income. But if markets decline, losses are magnified as well. Bank is therefore best suited for investors whose priority is maximizing monthly income and who are comfortable accepting a higher level of volatility in exchange for that potential. Next up is HMAX, currently yielding around 10.75%. Unlike Bank, HMAX doesn't use leverage. Instead, it relies almost entirely on an aggressive covered call strategy to generate its high monthly income. Specifically, HMAX writes at the money, or ATM, covered calls on up to about half of its portfolio. And at the money call has a strike price that's very close to the stock's current market price. Because there's a higher chance that the option will be exercised, investors are willing to pay a larger premium for it. Those larger option premiums are what help HMAX deliver such an attractive monthly distribution. But, as with everything in investing, there's a trade-off. Since a significant portion of the portfolio is covered with ATM calls, HMAX gives up more of its upside when Canadian bank stocks experience a strong rally. Compared with bank, HMAX doesn't take on leverage risk, but it sacrifices more upside through its covered call strategy. If your main objective is generating consistent monthly cash flow rather than maximizing long-term capital appreciation, HMAX can be an excellent fit. The key is understanding exactly how that income is being generated. Now let's move to ZWB, currently yielding around 4.60%. That's noticeably lower than bank or HMAX, but that's intentional. The lower yield comes from a more conservative covered call strategy designed to preserve more long-term growth potential. Like HMAX, ZWB writes covered call options on up to about half of its portfolio. The key difference is that ZWB writes out of the money, or OTM, calls instead of at the money calls. An out-of-the-money call has a strike price that's set above the stock's current market price. That gives the underlying bank stocks more room to appreciate before the option is exercised. Because those options are less likely to be exercised, investors pay a smaller premium, which results in a lower yield than HMAX. The benefit is that ZWB keeps more of the upside when Canadian bank stocks perform well. That's why many investors see it as a good middle ground. It still generates attractive monthly income while allowing for better long-term capital appreciation than more aggressive covered call ETFs. If you're looking for a balance between steady cash flow and long-term growth, ZWB is a compelling option. Now let's look at HCAL, currently yielding around 3.00%. At first glance, that yield may seem modest compared to the ETFs we've already covered, but that's because HCAL has a very different objective. Instead of maximizing monthly income, it focuses on enhancing long-term returns. Unlike bank, HMAX, and ZWB, HCAL doesn't write covered call options at all. That means it doesn't sacrifice any upside in exchange for option premiums. Instead, it uses approximately 1.25 times leverage to increase its exposure to Canadian bank stocks. Because there are no covered calls, HCAL can fully participate in rising markets, and the leverage can amplify those gains. Of course, the opposite is also true. If Canadian bank stocks decline, the leverage magnifies the losses as well, making HCAL more volatile than a traditional bank ETF. HCAL is best suited for investors who believe in the long-term strength of Canadian banks and are willing to accept higher short-term volatility in pursuit of greater total returns. If your priority is building wealth over time rather than maximizing monthly income, HCAL deserves a closer look. And finally, we have XFN, currently yielding around 1.94%. XFN is the simplest ETF on this list. It doesn't use covered calls, it doesn't use leverage, and it simply tracks Canada's financial sector through a traditional index fund. While the big six Canadian banks make up the majority of the portfolio, XFN also invests in other major financial companies, including insurance providers, asset managers, and other financial services firms. That gives investors broader exposure to Canada's financial sector rather than just the banks alone. Because there's no option strategy limiting the upside and no leverage increasing the volatility, XFN is designed to capture the long-term growth of the financial sector as directly as possible. Its yield is the lowest on this list because it relies primarily on the dividends paid by the underlying companies rather than generating additional income through options or leverage. If your goal is long-term capital appreciation with low costs and a simple investment strategy, XFN is an excellent core holding for gaining diversified exposure to Canada's financial sector. Bank delivers the highest income by combining moderate leverage with a covered call strategy on part of the portfolio. HMAX also targets high income, but instead relies on an aggressive at-the-money covered call strategy without using leverage. ZWB takes a more balanced approach by writing out of the money covered calls, allowing investors to retain more upside while still generating attractive monthly income. HCAL takes a completely different path, using leverage without covered calls to maximize long-term growth potential. And finally, XFN keeps things simple by tracking the Canadian financial sector through a traditional index fund with no leverage and no options strategy. As you can see, each ETF makes a different trade-off between income, growth, and risk. None of them is objectively better than the others, they're simply designed for different types of investors. The real question isn't which ETF has the highest yield. It's which strategy best aligns with your financial goals. So how do you choose? Start by identifying your primary objective. If maximizing monthly income is your top priority and you're comfortable with a more aggressive strategy, bank and HMAX deserve a closer look. If you want dependable monthly cash flow while preserving more long-term growth potential, ZWB offers an excellent balance between income and appreciation. If your focus is building wealth over the long run and you're comfortable with the additional volatility that leverage brings, HCAL may be a better fit. And if your goal is broad exposure to Canada's financial sector with low costs, no leverage and no covered calls, XFN is the simplest and most traditional choice. There's no universal winner here. The best ETF is the one that fits your objectives, your risk tolerance and the role you want it to play in your portfolio. A higher yield does not automatically mean a better ETF. More often than not, it simply means the fund is using a more aggressive strategy, whether that's writing covered calls more aggressively, using leverage, or combining both approaches. That's why it's so important to understand where the income is actually coming from. Every extra dollar of yield usually comes with a trade-off, whether it's lower growth potential, higher volatility, or both. One strategy that many investors use is combining different types of ETFs rather than relying on just one. For example, you might pair a higher income ETF such as HMAX or bank with a growth-oriented ETF like HCAL or XFN. That allows you to generate meaningful monthly income while still maintaining exposure to long-term capital appreciation, instead of sacrificing one objective entirely for the other. At the end of the day, don't chase yield, build a portfolio that matches your goals. The best ETF isn't the one with the biggest distribution. It's the one that helps you achieve your financial objectives over the long term. Now I'd love to hear from you. Which of these ETFs do you currently own? Bank, HMAX, ZWB, HCAL or XFN? Let me know in the comments below. And if you found this comparison helpful, don't forget to subscribe. Every week I break down Canadian ETFs and investing strategies to help you become a more informed investor.